The price of gold has skyrocketed in recent months, breaking the $5,000 mark for the first time ever. We'll break down why this happened and whether gold's value is likely to stay this high. The first and arguably easiest reason to understand for gold's rapid rise can be summed up in a single word: momentum. This is the easiest reason to understand why gold is climbing. When any asset starts performing very well in the markets, it doesn't take long for traders to take notice. And when assets continue to gain value over time, breaking and setting new records, the wider world starts to take notice too. Headlines and news reports push the story, and with every article, more people rush in eager to get involved. Fear of missing out, or FOMO, begins to set in. Some people realize how much money they might have made if they'd invested earlier, and they worry about missing out on more if they don't invest as soon as possible. It all starts off small, but it gets bigger and stronger with time. Momentum rises as more and more people decide to buy, and this drives the price up even further. We've seen this before, whether it be stocks, shares, cryptocurrencies, or commodities, and we're seeing it again right now with gold. Throughout 2025 into 2026, the precious metals value has soared, rising dramatically week after week, month after month. This is one reason gold may stay elevated or even become more valuable in the weeks and months ahead, since gold rallies have historically tended to last. Prior to 2025, in 5 of the 6 years when gold futures rose by at least 20%, they kept rising the following year. Because of that, momentum is one of the key forces pushing gold higher. But there's another major factor driving gold higher right now: diversification. Over the last year, many large private and institutional investors have started diversifying their portfolios, looking beyond stocks and shares instead of focusing on them almost exclusively. The shift was driven in part by the sudden surge in certain stock prices, with some reaching dramatic record-setting highs. Tech stocks have experienced enormous increases in recent times, with the likes of Nvidia, Tesla, and Amazon holding ever-increasing influence over the S&P 500 index. On the one hand, these surging stocks have delivered huge profits for investors who got in early. On the other, many experts believe that they can't keep rising forever. At some point, the bubble will burst as it has before, and that kind of collapse can be disastrous for anyone with too much money tied up in those assets. Analysts have been sounding the alarm over the current tech stock boom. They've pointed out that the only other time the stocks reached these kinds of valuations was right before the dot-com bubble burst in 2000. And no investor wants to be left holding the bag when that happens. That nervousness has pushed many investors to spread their money around, and as a result, demand for gold has surged in a relatively short period of time. Some have been purchasing physical gold bars and coins. Others have poured money into gold exchange-traded funds, or ETFs. Both lead to the same end results: greater investment in gold and a higher price tag. This, like momentum, is one of the reasons why gold has continued to gain traction in value. But it's not one of the root causes behind its skyrocketing surge. The next reasons help to explain how and why this price rise started in the first place, beginning with the weakening value of the US dollar. One of the simplest ways to predict changes of the price in gold is to watch what's happening to the dollar. Why? Because gold is priced in dollars. When the dollar weakens, gold becomes cheaper for buyers using other currencies. It's almost like a fire sale for anyone beyond the borders of the US, an open invitation to rush in and buy up as much gold as they can, as fast as they can, before its value begins to rise. Again, this is something that we've seen time and time again. When the US dollar weakens, the price of gold tends to move the other way. And lately, the dollar hasn't exactly been firing on all cylinders. Measured against other major currencies, the USD has been on a slow but steady slide since late 2022. It does bounce back, but those gains never seem to stick, with economic and political pressures continuing to weigh on it. And it doesn't look like it'll get any better anytime soon. Investors are growing uneasy that Washington could back Japan's efforts to strengthen the yen. At the same time, there are increasing concerns about the Federal Reserve's independence. Put together, it all adds another layer of uncertainty around currency policy, and it makes the future value of the US dollar harder to pin down. And when uncertainty creeps in, investors tend to gravitate toward neutral stores of value, like gold. Next up, the reason gold is often called the safe haven during global uncertainty. The world is not exactly in the most peaceful state at the moment. The global situation feels increasingly unpredictable, with rising political tensions, growing fears of conflict, and waves of economic turmoil rippling through the US and beyond. Times like these, when the world feels just a little unsteady, people, investors included, naturally start to look for stability wherever they can find it. And when it comes to investments, gold is about as stable as it gets. It's been trusted for thousands of years. Gold has held its value for centuries, weathering wars and some of the most dramatic political shifts the world has ever seen. In recent years, the conditions have put that stability front and center. The world has seen a global pandemic and numerous ongoing conflicts, all of which have reminded investors why gold still matters. Experts have long warned that the value of many major currencies, including the US dollar as well as stocks, could be on the decline. Rising national debts, along with a constant threat of tariffs and trade wars, are weighing heavily on economies around the world. In other words, the foundations holding up the global financial system seem to be starting to give way. As TD Securities expert investment strategist Daniel Gali puts it, gold's rally is about trust. For now, trust has been bent, but it hasn't been broken. If it breaks, momentum will persist for longer. And when trust in the system wavers, investors naturally look for alternatives, which is why gold demand rises. But if the global situation begins to stabilize, trust in other investments, like stocks and currencies, will likely start to return. Another reason gold tends to gain value comes down to an issue that feels especially relevant these days: inflation. Simply put, inflation is the rate at which the general cost of goods and services rises over time. And in modern systems, some level of inflation is almost inevitable. Prices will continue to rise as the years go by, but the speed of inflation can vary. There have been periods in history where inflation is minimal and effects really aren't noticeable from one year to the next. Then there are periods where inflation feels like it's spiraling out of control. Average families and households struggle to afford even the most basic and essential of goods and services due to the rising prices. The COVID-19 pandemic led to one of those periods, with inflation in many countries across the world surging in 2021, hitting record highs in 2022. Inflation has eased a bit in the US and other countries, but it's been a slow process. Prices for many goods and services are still climbing, making everyday living more expensive for a lot of people. When inflation runs high, people start to worry about the value of their money. Every dollar feels weaker, and even though inflation has started to fall, many still wonder how much their paper money and savings will actually be worth in the years ahead. So they look for ways to maximize the money they've got by investing in assets and commodities that can increase in value more effectively and efficiently, like gold. Many people see gold as a way to protect their purchasing power and avoid watching their currency lose value over time. And this is one of the main drivers behind gold's current rally. But there is another factor that can be even more impactful: interest rates. Like inflation and the US dollar, interest rates directly influence demand for gold and its value. Unlike bonds or savings accounts, gold doesn't pay interest. People buy it and store it, hoping its value will rise in the long term and make them a profit. Due to this, when interest rates are quite high, gold doesn't have quite the same level of demand. Instead, people tend to put their funds into savings accounts in order to guarantee themselves a certain amount of profit every 12 months. But when interest rates start to fall or reach lower than average levels, savings and bonds become far less appealing, and assets like gold gain ground. In 2022, when the Federal Reserve raised interest rates to tackle COVID-era inflation, investments like bonds and treasuries became the popular choices. But now, the US administration is working to bring interest rates down. Recent rate cuts have reduced the yields on government bonds and cash, pushing investors away from those assets and toward commodities like gold. At the moment, markets and investors are largely expecting central banks to cut interest rates even further, especially with a new Federal Reserve chair set to take office later in 2026. If that happens, gold could be an even more attractive option. Its potential upside far outweighs the low interest offered by the government bonds or savings accounts. Investors have been anticipating interest rate cuts for some time, so they've gotten in on the ground floor, buying up gold in advance to maximize their returns. The more this happens, the more gold's price rises. According to Goldman Sachs analysts, even a tiny 0.01% increase in private investment in gold-backed ETFs can push the price of gold up by 1.4%. The same trend is visible in other precious metals too. Silver recently surged past $100 an ounce, driven in part by rising demand as interest rates around the world continues to fall. But there's one more reason why gold has gained so much value in such a short amount of time, and perhaps it's the most important one of all: the central banks. In recent months, some of the world's biggest central banks, from China to India and Poland and Brazil, have been buying up large amounts of gold. And they have a few reasons for doing this, but the outcome is the same. By adding gold to their reserves, these banks diversify their holdings. This reduces their reliance on an increasingly shaky US dollar. This represents a major shift. For many years, central banks were actually net sellers of gold, selling more than they bought. But in 2010, that changed. They became the net buyers, accumulating more gold than they sold. Since 2022, their purchases have grown even more, particularly following Russia's invasion of Ukraine. Many countries' central banks have become increasingly aggressive in stockpiling gold. using it to stabilize their currencies and strengthen their assets with every new purchase. As Juan Carlos Artias, head of research at the World Global Council, notes, central banks are buying gold not just purely for its price performance, but the role it can play in foreign reserves. Gold is very useful to hedge or diversify the reserves. Central banks aren't like everyday investors or even large private investment groups. They have enormous spending power and they can buy gold in quantities most others can only dream of. Those massive purchases are a major driver of gold's price rise, and the more central banks decide to buy, the higher the price is likely to go. For all these reasons, many experts believe gold could remain a strong, potentially profitable investment well into 2026 and beyond. While no one can predict the markets with absolute certainty, the current factors seem to be working in gold's favor: ongoing political uncertainty, strong demand, and expectations of further interest rate cuts. And that leaves just one question: how high can gold go from here? Now watch What If the US Economy Crashes? Or click on this video instead.